Thank you. The advantage of being the last speaker is that I can refer to all the previous speech, saying that gentleman already mentioned this, but with a few thoughts, hopefully, in addition to those. In terms of the Goldman Infrastructure Fund, we manage around $10 billion of equity to be invested in infrastructure, and together with GIC, actually, we're a significant investor in Italian infrastructure. When we think about what would be an attractive asset for us to invest in as a financial investor, I can really think of four characteristics, I guess, and they're all about being sensible. I think we look for sensible demand, sensible regulation, sensible return, and then finally replicability, even though the last one is probably a nice to have, but a very important one to have. In terms of sensible demand, and it goes through, I think, some of the core theme we discussed during this conference is, as a financial investor, the role in us investing in infrastructure is not for that investor to create jobs. On the other hand, it's very important for us to understand that it will do so. And the link, in effect, is that, for us to invest money for a very long period of time, we know that there is support for that investment. And the way to, in effect, give us comfort there is that support is because that infrastructure is going to be needed. There will be, I think, nothing good for us in investing into something which only is going to make us our return because there is 90% of the revenue coming from subsidies. At some point, someone will say, hang on, why are those investors getting that kind of money? So sensible demand for us means let's just make sure there's natural demand for that service that people will be willing to pay today, tomorrow, and in the foreseeable future. And that requirement of ours also means that we typically, as a financial investor, would not be the first one to invest in any kind of project where there's a significant technological risk. Because if there is a significant technological risk, that means that the demand may be there, but someone else with different technology may be able to provide that service. So we'd be looking for something that that is going to be there no matter what technology or where our investment is going to make its return before technology has likely changed. In terms of the other thing we look for is sensible regulation, and it's the theme that I think GIC has mentioned and some of the previous speakers as well. We pretty indifferent with the kind of regulation, and if you look across Europe, I'm very broad brush about it, there are a lot of exceptions, but utilities in Europe, in terms of the network of utilities, tend to be regulated on a RAB basis. So regulator says, here's an asset base and here's the return you can get on it. Transport is much more about a concession, a contract, where you get paid through a toll of the user or some sort of payment by the public sector. Telecom is very much a hybrid with a lot of question about financing the digital agenda at the moment. And social infrastructure is really a combination of a lease model and operating contract. So they're all different, and I guess we're happy with all of them. What matters for us is that the way those regulations have been put together, regardless of what they are, have been done in a very sensible fashion. And if I try and do a typology of it, I think the key one would be, can we have an adult conversation with the regulator? Is it possible to understand what has put the regulation together? Do we understand what's going to make it change? Are we going to have some notice in case there is a change? And are we going to, are we not going to be caught by a surprise? I think one traditional thing about infrastructure investors is don't like surprise. The thing about regulation also, obviously, that's not just economic regulation. Of course, that's the key one, that's what drives return. But it's all the other regulation are also a factor. So how long before you get permits, construction permit, operating permits? How stable is the fiscal environment? I mean, in Eastern Europe, we recently were an investor in an airport which built a terminal, and there were a need for more than 100 permits for that terminal to open. It got done, but the question is, is that going to help make further investment or quick investment? The third thing we'd be looking for would be sensible returns. I was very happy on the previous panel to see Benis Maggi, who mentioned that, clearly people put their money because they expect to make a return. We tend to be, and I think all financial investors should be, risk-adjusted returns. So we're not going to be looking for the same type of return if we go for highly regulated utility versus a demand-led airport project, for example. But a fair level of return, of course, is what our investors pay us to get. And our investors, by and large, are pension funds and sovereign funds. They are the ones who have the kind of money that can take such a long-term approach. So basically, what they're looking for is not a home run like private equity, like David mentioned, but really long-term stable return. The only thing I'd add to that is that the structure of that return is at least as important as the absolute level, is that we would view much more favorably an inflation-linked return, or a return which is explicitly inflation-linked by the regulation than an absolute one. Given what's going on in the macro environment in Europe, it's something which is very valuable for investors. The last thing I'll mention is replicability, and that may seem strange, but in effect, as a financial investors, my job is to deploy capital. We get paid by our investors to give them return, and so for us, there's only one way to do that, is to actually invest. And so given that we have to decide where we spend time, where we spend money, having a sector or having a country where there's a possibility of repeat investment, either because the investment will need to expand or because there will be further investment in similar sector, is very valuable. So I guess the only message would be sell more rather than less, invite capital for more than less. I think that the capital can be found for the right project, and there is a threshold level which is important for investors like us, of making sure that the effort we make to understand the regulation, to understand the stakeholders, to establish a relation with the regulator can be in effect leveraged and replicated and further deepened over time. I think part of the question related to this is the tenor of investment, and there's no right or wrong model. I think there are multiple ways to do this. In terms of all infrastructure investors will be long-term investors, but there are really two parts to a traditional infrastructure investment. There is the original construction phase, and then there is the operation phase for the remainder of the concession or the life of the assets. And typically, I think you start very slowly to see in Europe that this model has become better established, that there are people who are better than us at taking that first phase of that investment, and then we can recycle that capital and keep it for the long term. I'm conscious of time, but happy to expand on any of those topics.
Thank you.